Imagine waking up one morning to a financial earthquake, not in some distant market you barely follow, but one that could reshape the global economy, shake Main Street, and touch the price of the things you buy every day. That's exactly what happened on the night the world woke up to Japan dumping a staggering $50 billion in U.S. Treasury bonds overnight, a move so unexpected that some traders literally dropped their coffee in disbelief. For decades, U.S. Treasuries, especially long-term ones like the 10-year T-bond, have been considered the safest place to park money on earth, the financial equivalent of putting cash in a vault under Fort Knox. But last night, that belief was shaken. What we're calling the T-bond rejection didn't just rattle Wall Street, it sent shockwaves through boardrooms in Tokyo, bond desks in London, and dining tables from New York to New Delhi. For many people, the phrase U.S. Treasury bonds doesn't mean much. But in the financial world, these pieces of paper represent the backbone of the global economy. Governments, pension funds, insurance companies, and even entire countries buy these bonds because they are supposed to be the safest investment you can make. They help finance the U.S. government, keep interest rates low, and serve as a kind of global savings account everyone trusts. Yet on this one night, Japan, historically one of the biggest holders of U.S. government debt, seemed to say, no thanks. Overnight, $50 billion worth of treasuries was sold or liquidated, creating a sell-off that no one saw coming. This wasn't a small, quiet slide, it was a dramatic motion, the kind that gets traders grabbing their phones, central bankers scrambling to understand what's happening, and pundits on financial news networks screaming that something big is unfolding. And the buzzword on everyone's lips, T-bond rejection. The idea that Japan's move wasn't just selling bonds, but rejecting what has long been the symbol of American financial dominance. So who exactly is Japan in this story? To understand the magnitude of this moment, you have to go back decades. Since the late 20th century, Japan has built up an enormous pile of U.S. treasuries, often topping the charts as one of the largest foreign holders of U.S. government debt. This was part strategy, part financial prudence, a way to earn reliable returns while keeping the Japanese economy stable. But over the last few years, something changed. The size of Japan's economy, its debt burden, its relationship with its own currency, and its political dynamics all evolved in ways that left financial experts scratching their heads. Japan's appetite for U.S. treasuries began to wane, and in certain months, its holdings actually shrank as investors pulled back or shifted capital elsewhere. DBS. Imagine that shift not as a gentle drift but as a dramatic pivot, hundreds of billions of dollars, gradually exiting a market that once depended on steady Japanese buying. That's the backdrop to the headline you just heard. The question isn't just, why did Japan sell $50 billion in treasuries? It's also, why now? What combination of economic forces, diplomatic friction, shifting strategies, and market psychology pushed one of the most powerful financial players on the planet to make such a dramatic move? Part of the answer lies in something called yield spreads. Basically, the difference in returns between Japanese bonds and U.S. bonds. For years, Japanese government bonds, JGBs, offered painfully low yields, sometimes close to zero. Meanwhile, U.S. treasuries, especially long-term ones like the 10-year note, paid more. That made treasuries attractive. But as global markets adjusted, inflation expectations shifted, and central banks changed course, those spreads began to narrow. Suddenly, the advantage of holding foreign bonds wasn't as obvious as it used to be. That pushed some Japanese investors to rethink their strategy, and some began to bring money home, or look for higher-yielding opportunities elsewhere. DBS Bank. At the same time, the Japanese yen, a currency that has historically been weak but stable, began to show signs of volatility. As investors anticipated interest rate changes and the Bank of Japan gradually moved away from decades of ultra-loose monetary policy, the yen's role in global currency markets shifted. A stronger yen could make holding U.S. treasuries less profitable after you convert back into yen. A weaker yen, sometimes tied to domestic economic concerns, could make foreign assets more expensive to buy. These currency dynamics are not just numbers on a screen. They affect real lives, from the price of imported goods in Tokyo to the value of Japanese tourists' wallets abroad. DBS Bank had, to that, a backdrop of geopolitical tension and trade frictions around the world. Friction between major economies, especially between the United States and its trade partners, has intensified. High tariffs, protectionist moves, and growing economic nationalism have changed the calculus of what it means to be strategic in global finance. Japan, an export-dependent powerhouse, has sometimes found itself in a delicate dance with Washington. In certain public statements, Japanese officials have even referred to their Treasury holdings as a sort of card on the table in diplomatic negotiations, a leverage point in high-stakes discussions over trade and technology. Axios, but here's the twist. Nobody in Tokyo or Washington has officially said they deliberately dumped $50 billion in treasuries as a political statement. The reality is far more complex and far more intriguing. Some of the selling may have come from private institutional investors, pension funds, and insurance giants who manage trillions in assets and make decisions based on risk, return, and the global economic climate. Others may have been reacting to technical market pressures, hedging risks, or rebalancing portfolios in response to rising yields at home. Yet the timing and scale of the move have left analysts wondering if a broader strategic shift is underway, not just in Japan's investment behavior, but in how the world views U.S. debt itself. Here's what makes this moment so dramatic. For decades, U.S. Treasury bonds were considered the safest asset in the world. You could run wars, send a man to the moon, or weather global financial crises and treasuries would still be there, quietly funding government obligations while offering reliable returns. But now, with the world dealing with rising debt levels, unpredictable monetary policy, and an evolving balance of economic power, that sense of safety feels more fragile. When Japan, the world's largest foreign holder of U.S. debt for so long, makes a move like this, markets listen. The reaction was immediate. Bond prices tumbled, yields, which move inversely to prices, spiked. Traders saw this as more than just a sale. They saw it as a loss of confidence. Stocks wavered. Economists began examining what this could mean, not just for the U.S. economy, but for global financial stability. If a major holder like Japan is trimming its exposure to treasuries, who might follow? And what happens if this isn't just a one-off event, but the start of a larger trend? So far, data suggests shifting patterns in how global players hold U.S. treasuries, some increasing, some decreasing, but none as dramatic or sudden as what we saw tonight. Futu News. As we tell this story, Wall Street analysts are still slicing through the numbers, central banks are reconvening emergency sessions, and ordinary investors around the world are trying to make sense of what this means for mortgages, interest rates, and the overall direction of the economy. And yet, even with all this chaos, one thing is still unclear. Was this $50 billion move a strategic pivot, a market reaction, or a warning shot that something much larger is brewing behind the scenes? In the next part of this video, we're going to dive deeper into who stood to gain and who stood to lose from this sudden treasury sell. We'll look at the reactions from governments, markets, and everyday people whose savings and futures could be affected. We'll examine whether this was a calculated shift by Japan, a symptom of underlying global tensions, or something else entirely. But before we go there, take a moment to let this sink in. The financial world has always moved quietly, with numbers and charts and trends. Yet sometimes, one giant move, like Japan's overnight rejection of $50 billion in U.S. treasuries, can upend assumptions, redraw financial maps, and leave the world asking the same question the next morning. Traders in New York rubbed their eyes and stared at screens that didn't make sense. Charts that were supposed to rise had fallen. Numbers that normally moved in smooth lines were jagged and unpredictable. The U.S. Treasury yield curve, once a familiar and comforting map of economic expectations, looked like it had been redrawn overnight. People across financial markets kept asking the same question. Why did Japan sell so much so fast? But behind that simple query was a cascade of deeper questions. Questions that had no easy answers. To understand what was happening, we need to go back further, not just to the night of the sell, but to the years of economic behavior that set the stage for it. In Tokyo, in corporate offices and government ministries, decisions were being made about how to manage vast pools of capital. Japan's economy has long faced unique challenges: a shrinking population, stubbornly low inflation, and a public debt that, relative to the size of the economy, far exceeds that of any other developed nation. These pressures have shaped Japan's financial strategy for decades, and the way it uses foreign assets like U.S. treasuries is at the center of that strategy. For years, Japan leaned on U.S. debt as a kind of economic anchor. Buying treasury bonds was considered safe, reliable, and a way to earn modest returns while keeping the Japanese yen stable. Government agencies, pension funds, and financial institutions alike saw American Treasuries as part of the foundation of a balanced portfolio. But over time, the world changed. Central banks around the globe, including the Federal Reserve and the Bank of Japan, shifted their policies in response to inflation, recession fears, and global crises. What had once been a predictable relationship became new and uncertain. In the United States, the Federal Reserve raised interest rates several times in an effort to control inflation, pushing yields on long-term bonds higher. That made older Treasury bonds with lower interest rates less attractive. Investors began to demand better returns, and that changed the calculus for foreign holders. Meanwhile, in Japan, the Bank of Japan began moving away from decades of ultra-loose monetary policy. These changes, small when viewed in isolation, slowly built pressure beneath the surface of global markets. Across trading floors, whispers became conversations. Analysts started noticing unusual patterns in Japan's Treasury holdings long before the dramatic sell. Month after month, data from the U.S. Treasury Department hinted at a gradual decline in Japanese ownership of certain classes of bonds. Some months the drop was barely noticeable. Other months it was significant. But because markets are always moving, it was easy for many investors to dismiss it as part of normal ebb and flow. Yet in Tokyo, strategists saw something different. A slow shift in how their country was positioning its capital. They could feel a change in the air, even if outsiders couldn't yet articulate it. This context is critical because the $50 billion Treasury sell-off * didn't happen in a vacuum. It was the culmination of trends that had been building for years. Some of those trends were economic, some were political, and some were psychological. The kind of subtle shifts in confidence that don't show up on an economic report until after the damage has already been done. In boardrooms in Tokyo, conversations once centered on stability and risk management began to include new topics. What happens if the U.S. economy slows? What if interest rates rise faster than expected? What if our own bond market becomes more attractive relative to foreign debt? These questions weren't hypothetical. They were real and urgent. The answers were uncertain. Meanwhile, back in Washington, policymakers were watching their own set of signals. The U.S. government continued to issue more debt to cover budget deficits, pushing the total amount of outstanding treasuries higher and higher. This was not a secret. It was widely reported and debated. But what was less understood was how foreign holders would react to this increasing supply. Some economists argued that the world's appetite for U.S. debt was effectively limitless because of the dollar's reserve currency status. Others warned that there are limits, and that once major holders began to change course, the effects could be dramatic. In London and Frankfurt, traders compared notes. Some saw the sell-off as a technical reaction, a response to short-term market pressures. Others saw it as something more symbolic, a potential shift in confidence toward American debt. The fact that Japan was the one making such a large move only heightened the suspense. Japan wasn't a small player. It wasn't a fringe investor. It was one of the pillars of the global financial system. And seeing it retreat from U.S. Treasuries raised eyebrows. But what was really driving the tension wasn't only economic, it was the unknown. Markets hate uncertainty, humans hate uncertainty, and when a country with so much historical connection to U.S. debt suddenly makes a dramatic move, the unknown becomes a much bigger force than any single economic indicator. People started asking, is Japan signaling a lack of confidence in the U.S. economy, or is it simply acting in its own self-interest? And can other countries follow suit? On the streets of Tokyo, ordinary citizens felt the tremors in different ways. Some retirees with savings tied to government bonds worried about what rising yields might mean for their income. Business owners, already navigating the challenges of a global supply chain and fluctuating currency values, wondered how this shock would reverberate. And everyday investors, watching news tickers and scrolling headlines, felt an unease that's hard to quantify but impossible to ignore. In New York, Wall Street analysts scrambled to find patterns. Some dug into historical data, searching for precedent. Others reached out to contacts in Asia, trying to piece together insider insights. Every market report, every diplomatic press release, every rumor became a potential clue in a puzzle that no one could fully solve. Was this sell-off a one-time event, or the harbinger of a larger shift in global capital flows? As the day wore on, the tension only built. Financial news channels replayed reactions from traders still in disbelief. Economists debated on live TV whether this move was a strategic pivot or a reaction to deeply rooted financial forces. Social media buzzed with theories and speculation, some grounded in expertise, others driven by fear or rumor. But through all the noise, one theme stood out. No one was certain what came next. Behind the headlines and the analyst chatter, there was another layer of complexity. Governments rarely speak openly about their strategic financial decisions. There are diplomatic considerations, political calculations, and international pressures that don't make it into public statements. In Tokyo, officials maintained a calm, measured tone in their communications. They assured the world that Japan remained committed to global financial stability and that its economic policies were guided by domestic needs. But the silence on certain questions, particularly about future Treasury holdings, was deafening. What was not said became almost as important as what was. And then there was the human element, the real people whose jobs, savings, and futures were tied up, in part, with the direction of global markets. From pension fund managers in London to small business owners in Chicago, people felt the ripple effects. Some saw opportunity, others saw risk, but everyone felt the tension. In the midst of all this, one question loomed larger than the rest. If Japan's move wasn't an isolated incident, then what happens if other major holders of U.S. debt follow its lead? China, another massive holder of treasuries, had been quietly adjusting its portfolio in recent years. But how quietly? And were those adjustments a response to market forces, or part of a broader strategic shift? No one had a definitive answer. As markets closed for the day, the bond yield still fluctuated. The price of the 10-year Treasury was unsettled. The dollar's exchange rate shifted as currency traders reacted. And beneath all of these measurable movements was a deeper, more intangible shift, a sense that something fundamental was being questioned. Some analysts compared this moment to other historical inflection points, sudden shifts that only in hindsight appeared obvious, moments when markets changed behavior, not because of a single event, but because conditions had built up over time, until they reached a tipping point. Was this one of those moments? Or was it a dramatic blip, loud, shocking, but ultimately temporary? By the time evening fell in New York and London, and late night in Tokyo, the world was left with more questions than answers. Economists would continue to pore over data. Markets would open the next day and test new levels. Political leaders would prepare responses, and everyday people would watch and wait, trying to understand how this financial tremor might touch their own lives. But one thing was clear: the T-bond rejection, whatever its causes, had cracked open a story far more complex and unsettling than most had expected. And the mystery wasn't going away. Not today, not tomorrow, not until we understood what this sudden sell-off really meant, not just for markets, but for the balance of economic power in the world. And so, as night settled across continents, a global audience braced for what would come next, knowing that the answer, if it ever came, would not be simple. And the tension, far from resolved. The following morning, the world woke again. But the tremors from Japan's $50 billion sell-off were far from settling. Traders poured into offices, analysts stared at dashboards, and reporters scrambled for angles that would explain a move that defied easy logic. Every headline screamed the same theme: uncertainty. And in uncertainty, fear and speculation breed quickly, spreading faster than any actual market data. Some saw opportunity, some saw catastrophe, few saw clarity. In Tokyo, a meeting was underway in a high-rise overlooking the Sumida River. Behind glass walls and sleek desks, Japan's financial strategists debated what had been set in motion the night before. Some argued that the sell-off was a simple market adjustment, a long overdue correction, after years of steady treasury accumulation. Others suspected it was more deliberate, a signal, a statement, a repositioning of Japan's financial priorities. One official whispered that it wasn't just about dollars or bonds. It was about influence, leverage, and even caution in a world where economic alliances are constantly shifting. No one could say for sure how far the implications would go. Meanwhile, across the Pacific, U.S. policymakers were quietly assessing the ripple effects. At the Treasury Department, aides and advisors pored over spreadsheets, charts, and foreign holding data, trying to predict whether this of intensity. In Washington, discussions in government offices and financial committees grew increasingly heated. Lawmakers and economic advisors debated whether Japan's move was purely financial or if it carried geopolitical undertones. Some suggested that the sell-off was a subtle message, a form of leverage in negotiations between two powerful nations. Others cautioned that reading too much into it could inflame tensions unnecessarily. Every statement, every report, every press briefing was analyzed for clues. Yet none gave a clear picture of what the future might hold. Across Asia, similar tensions were mounting. South Korea and China monitored Japan's moves with caution. Investors in Singapore, Hong Kong, and other financial hubs adjusted positions in response to shifting bond prices and yields. Economists warned that a chain reaction was possible, that the T-bond rejection could inspire similar strategies in other countries or institutions. Social media amplified every development, making speculation viral and urgent. Ordinary people who had no direct connection to bonds or treasuries felt the ripple effects in rising currency volatility, shifting loan rates, and the general sense of global unease. In Japan's financial ministry, high-ranking officials met late into the night. Charts and graphs were projected across screens, showing the shifting holdings of US debt, movements in currency exchange rates, and domestic market reactions. Some argued for restraint, emphasizing the need to avoid panic and maintain stability. Others pressed for action, seeing opportunities or risks that could not be ignored. The debate was intense, the stakes enormous. Every word, every decision carried consequences that could echo across continents. Meanwhile, on Wall Street, small investors nervously followed the headlines. Some had invested in Treasury bonds directly. Others had money tied to mutual funds or retirement accounts. Every fluctuation in yields or prices created anxiety. Conversations in coffee shops and living rooms increasingly revolved around the same questions. What does this mean for the U.S. economy? Will interest rates spike? Could this trigger a global crisis? For many, the story of Japan's sudden sell-off was no longer abstract. It was personal. Amidst all this, market analysts began to notice subtle but troubling patterns. Other countries' holdings of U.S. debt were showing small but consistent changes. Institutional investors were rebalancing portfolios, seemingly in response to the volatility. The once stable foundation of U.S. Treasury bonds, a symbol of global financial certainty, was now showing cracks. Every adjustment, every calculation, added layers of suspense. The feeling across trading floors and policy rooms was unanimous. Something bigger was unfolding. The psychological tension was compounded by the sheer unpredictability of the situation. Japan's actions had set in motion a chain of events that could not be controlled or fully anticipated. In offices from New York to Tokyo, analysts tried to model the potential outcomes, but the variables were overwhelming. Geopolitics, interest rates, domestic policies, currency fluctuations, investor sentiment, all intertwined in ways that made the future uncertain. People felt the pressure of waiting for the next move, the next signal, the next moment that might tip the scales. Bought in homes and offices around the world, conversations became speculative. Friends debated the causes and potential consequences of the sell. Families worried about mortgages and savings. Employees at investment firms felt a mixture of excitement and fear as they tried to anticipate the next wave of market movements. Even for those not directly involved in finance, the tension was palpable. The story of Japan dumping $50 billion in treasuries had moved beyond the financial sector and into the consciousness of everyday life. As night fell again over Tokyo, Wall Street, and London, the anticipation reached a peak. All eyes were on the next day's market open, on the next announcements, on the subtle signals that could indicate whether this was an isolated shock or the beginning of something far more consequential. The threads of human, financial, and political tension were all interwoven, creating a narrative filled with suspense, uncertainty, and high stakes. And yet, for all the analysis, speculation, and preparation, the central question remained unanswered. What is Japan really trying to accomplish? The markets were primed, the world was watching, and the tension had reached its highest point. Every movement, every statement, every adjustment could trigger reactions with global consequences. As the night deepened, the sense of anticipation became almost tangible. People across continents felt the weight of waiting, of watching, of imagining what might come next. The story of the T-bond rejection had grown far beyond numbers on a screen. It was now a tale of human emotion, national strategy, and global uncertainty. And somewhere, in the quiet hum of financial centers, government offices, and homes, everyone knew that the next moments could be decisive, even if the resolution was still out of reach. The world was poised on the edge of revelation. The suspense was unbearable, and the stakes had never felt higher. No one could predict what would happen next, but everyone knew that the next move would shape the course of markets, governments, and lives for years to come. The climax was approaching, and the world waited, holding its breath. Just as the world braced for another day of market chaos, an unexpected signal appeared, one that no one had predicted. In the early hours of Tokyo trading, whispers began circulating that a second wave of Treasury adjustments was underway. But this wasn't coming from Japan's usual institutional investors or government accounts. This was a new player, moving quietly, strategically, and on a scale that immediately drew attention. Traders noticed subtle shifts in holdings from a series of smaller, yet highly influential, financial institutions across Asia and Europe. It wasn't just a reaction to Japan's sell-off. It felt deliberate, almost coordinated. The news spread like wildfire. On Wall Street, analysts scrambled to interpret the data. "It's not a follow-up," one trader muttered. "It's something else entirely." Every algorithm, every model, every projection suddenly seemed insufficient. Bond yields jumped again, but this time in unpredictable patterns. The market had expected volatility, but no one had anticipated a hidden player escalating the situation so dramatically. It wasn't just about the $50 billion Japan had sold overnight. Now, the entire structure of U.S. Treasuries was being tested. In Tokyo, officials felt a surge of alarm. The Ministry of Finance convened an emergency meeting. The faces around the conference table were tense, voices low but urgent. Some suggested that Japan's move had unintentionally exposed vulnerabilities in the global bond market. Vulnerabilities that others were now exploiting. Others wondered if this was a calculated response by foreign institutions, an attempt to capitalize on Japan's decision while reshaping market dynamics to their advantage. It was a revelation that made even seasoned policymakers uneasy. The sell-off had opened a door, and someone else had walked through it. Meanwhile, across Europe, hedge fund managers were quietly reporting massive internal real. Banks in Frankfurt and Paris adjusted their portfolios, moving large sums of capital in ways that suggested they anticipated not only more Treasury volatility but also shifts in currency values and domestic interest rates. The implications were enormous. If these smaller but strategic players continued to move, it could create a domino effect, forcing other countries to respond in kind. Analysts warned of cascading pressure that could ripple far beyond U.S. markets into emerging economies, currency markets, and global trade. The human impact of this twist began to surface. In Singapore, a family-owned investment firm watched as their carefully balanced treasury positions fluctuated wildly. A young portfolio manager stayed at the office long into the night, running calculations and making calls, knowing that one wrong move could cost the firm millions. In New York, pension fund managers debated whether to hold or sell, aware that their decisions could directly affect retirees relying on steady bond income. Across continents, people who never considered themselves part of a global financial story suddenly felt the tension in a very personal way. Back in Washington, advisors debated not just financial consequences but potential geopolitical ones. Was this second wave purely opportunistic, or did it carry a strategic message? Could it signal a coordinated push by foreign investors to assert leverage over U.S. debt markets? Officials were particularly concerned about the implications for international diplomacy. Every policy memo now included a warning. Global reactions could escalate if confidence in treasuries appeared fragile. The stakes had risen from economic stability to a matter of national strategic interest. Meanwhile, social media amplified the suspense. Financial bloggers, influencers, and journalists speculated on the identity of this mysterious second wave. Was it a secret consortium of banks, a hedge fund syndicate, or could it even hint at government involvement from another country? Each post, tweet, and analysis added fuel to the fire, sending ordinary investors into panic or frenzy. The story had grown beyond numbers and charts. It was now a narrative of uncertainty, strategy, and unseen power, gripping a global audience. In Tokyo, the mood in trading floors and government offices became almost frantic. Analysts pulled up historical comparisons, trying to find precedent for a sudden, strategic escalation. Tyone in Treasury sales, some noted minor events from the past, but nothing approached the scale or speed of what was now unfolding. Senior officials discussed contingency plans, stress tests, and emergency measures. Every option carried risk, and every decision could have unforeseen consequences. The sell-off, once seen as a single event, had grown into a multi-layered conflict challenging the foundations of global finance. Even the media began reporting in a tone usually reserved for crises. Headlines emphasized the unprecedented nature of the activity. Global bond market on edge after Japan's T-bond sell-off sparks second wave. Treasury yields spike as mysterious players move billions. Financial experts warn of cascading risk in U.S. debt markets. The language alone heightened anxiety, creating a feedback loop where perception influenced action. Investors reacted not only to market signals, but to the fear of what others might do next. And then came subtle clues that raised the stakes even further. Analysts noticed that the mysterious movements weren't random. Patterns suggested an awareness of Japan's positions, timing trades to maximize effect. It was as if someone had studied the sell-off, anticipated its consequences, and moved precisely to create maximum impact. For traders and policymakers alike, the realization was chilling. This was no ordinary market fluctuation. This was strategy, and it was happening in real time. The global economy, which had always seemed stable in its routines, now felt fragile. Bond prices, currency rates, and interest expectations were all in flux. Governments and financial institutions watched nervously, calculating responses, anticipating reactions, and trying to avoid triggering panic. At the same time, ordinary people who had invested, saved, or planned based on the traditional stability of treasuries suddenly felt exposed. The story had transformed from a single dramatic event into a web of suspense, strategy, and uncertainty, leaving everyone on edge. Even within Japan, whispers spread of internal disagreements. Some officials argued for a careful approach, holding steady to avoid global panic. Others advocated for aggressive maneuvers, suggesting that Japan's initial move could be leveraged to strengthen domestic financial standing or strategic advantage. The debate underscored a critical reality. Even among those who initiated the first sell-off, uncertainty and tension were escalating. The second wave had changed the rules. As the day wore on, the anticipation for what would happen next reached a fever pitch. Analysts warned that markets could experience explosive movements if the second wave continued. Traders stayed at their desks long after hours, eyes glued to screens, ready to act on the slightest signal. Families, business owners, and retirees followed developments with a mixture of anxiety and fascination. Headlines screamed, social media buzzed, and financial hubs around the world held their collective breath. The story had grown into a high-stakes drama, where economic, political, and human elements intertwined. Japan's initial $50 billion sell-off had sparked a second, unexpected escalation, raising questions about global financial stability, international strategy, and the hidden forces shaping markets. Every new development added suspense, leaving the world on the brink of revelation but with no answers in sight. And as night fell once again across Tokyo, New York, and London, the sense of urgency and uncertainty reached its peak. Everyone understood that the next moves would define not only markets, but potentially global economic and political dynamics. Yet the ultimate outcome remained elusive. The tension had never been higher, the stakes never greater, and the world was waiting, collectively holding its breath, for the climax that seemed both inevitable and impossible to predict. The world waited, tense and uncertain, as markets opened the next morning. Trading floors from Tokyo to New York were electric with anticipation, the air thick with a sense that something historic was unfolding. For weeks, the drama of Japan's $50 billion T-bond sell-off had dominated headlines. But now the second wave of mysterious moves was converging with Japan's strategy in a way no one had fully anticipated. Traders, policymakers, and investors all felt the weight of the moment, the culmination of months of subtle shifts, speculation, and hidden pressures. In Tokyo, the Ministry of Finance had made a calculated choice overnight. Rather than continuing aggressive selling, officials decided to stabilize domestic markets while maintaining a smaller, controlled reduction of Treasury holdings. The message was clear: Japan would not abandon its strategic role in global finance, but it would assert new autonomy over its capital. This decision rippled outward instantly. Analysts realized that the first sell-off, The $50 billion move had been less about panic and more about sending a precise signal, a declaration that Japan's tolerance for risk in U.S. debt was changing. Across the Pacific, the U.S. Treasury reacted cautiously but decisively. Emergency calls and meetings had kept advisors and policymakers awake all night. They assessed the global impact, recalibrated interest rate expectations, and coordinated with private institutions to stabilize the market. By mid-morning, the T-bond yields began to find footing, though volatility remained high. The U.S. government's measured response reassured some investors that, despite the shocks, the underlying strength of the economy remained intact. Then, as the morning progressed, the world witnessed the most dramatic twist yet. The mysterious second wave revealed itself not as a rogue group of investors, but as a coordinated effort by a consortium of smaller nations that had quietly diversified their holdings of U.S. Treasuries. They had watched Japan's initial move, interpreted it as a strategic opening, and begun a carefully orchestrated rebalancing to protect their own interests. This revelation stunned analysts and traders alike. What had seemed chaotic and potentially dangerous was, in fact, a calculated adjustment by nations seeking to manage risk in a changing global financial landscape. The markets reacted in real time. Volatility remained, but clarity began to emerge. Investors adjusted positions with a new understanding. The T-bond sell-off had been both a warning and an opportunity. Japan's assertive move, combined with the second wave by smaller nations, created a subtle shift in power, one where global financial stability would now rely more on coordination and foresight than blind confidence in historic norms. Wall Street slowly absorbed the news, trading cautiously but steadily. Tokyo's markets calmed, signaling that Japan's strategy had worked as intended. It had forced a reassessment without triggering collapse. Amid the financial drama, the human stories continued to unfold. In New York, a retired couple saw their pension account recover slightly as markets stabilized. In London, a young trader who had feared losses breathed a quiet sigh of relief, realizing that strategy and careful observation had prevented disaster. Across Asia, small investment firms began to adjust to the new reality, understanding that the global debt landscape had shifted, not through chaos, but through intention and careful orchestration. And just as the world seemed to settle, the final twist emerged, one that no analyst, policymaker, or investor had anticipated. Reports began to surface that an undisclosed hedge fund, previously unknown in the global finance sphere, had quietly coordinated some of the second-wave movements, leveraging small positions to influence markets on a scale far beyond what anyone expected. This fund had not only anticipated Japan's move but had strategically timed trades to accelerate reactions across multiple markets. The revelation created a ripple of disbelief. Even as the T-bond crisis appeared resolved, there was now a new layer of uncertainty, the realization that unseen actors could influence global financial systems in profound ways. The climax of the story was complete. Japan had asserted its new strategy. The second wave of nations had revealed a coordinated, stabilizing response, and the T-bond market had weathered shocks without collapse. Confidence began to return, yet the unexpected role of the hedge fund left the world with a lingering question. If a single, obscure player could influence markets so dramatically, what other surprises might the global financial system hold? As markets closed for the day, analysts, policymakers, and investors reflected on what had transpired. The main conflicts, Japan's T-bond rejection, and the mystery of the second wave, had been addressed. But the story ended with suspense intact. The world understood that global finance was no longer a static system of predictable moves. It was dynamic, human-driven, and influenced by forces both seen and unseen. And somewhere, in the quiet offices of Tokyo, New York, and an unassuming hedge fund office hidden from view, the next move was already being considered. The resolution of this chapter had been dramatic, strategic, and intense. Yet the final twist reminded everyone that in the world of global markets, the story is never truly over. It only evolves. The days after the dramatic T-bond saga unfolded with a mixture of relief and lingering tension. Markets that had trembled under the weight of Japan's $50 billion sell-off, and the second wave of strategic adjustments began to settle into a new rhythm. Traders, analysts, and policymakers across the globe breathed a